You have debt. You also want to start investing, and everyone around you has a strong opinion about which one you should do first. Pay off everything before you invest a single dollar, or start investing immediately because time in the market matters more than anything else. Both of those positions sound reasonable. Both of them are sometimes completely wrong. The answer to this question is not a rule. It is a calculation. And once you know the one number that drives it, the decision becomes straightforward. By the end of this video, you will have a clear framework for making this decision for your specific situation, not a general rule that may not apply to you. Quick note before we start. This video is for educational purposes only and is not personalized financial advice. Getting this decision wrong in either direction has a real cost. If you focus entirely on paying off debt before investing and that debt carries a low interest rate, you're potentially sacrificing years of compound growth. Time in the market is one of the most powerful variables in building wealth. Every year you delay investing is a year of compounding you cannot recover. But the opposite error is just as damaging. If you're carrying high-interest debt and you invest instead of paying it off, you're almost certainly losing money in net terms. Paying 18% interest on a credit card while earning 7% in the market means you are going backwards by 11 percentage points every single year. The math is not in your favor. The reason most advice on this topic fails is that it treats everyone the same. The right answer depends entirely on one variable: the interest rate on your debt. Here is the framework that makes this decision simple. The long-run average annual return of a broad market index fund is approximately 7% per year. That is a conservative historical estimate based on decades of data. It will not be exactly 7% every year, some years higher, some years lower, but over the long run, 7% is a reasonable working number. Now look at the interest rate on your debt. If your debt charges you more than 7% per year, paying it off gives you a guaranteed return equal to that interest rate. Paying off a debt charging 10% is a guaranteed 10% return, better than what the market is likely to deliver and with zero risk. If your debt charges you less than 4% per year, the math generally favors investing alongside it. Your expected market return is likely to outpace the cost of your debt over the long run. Paying it off aggressively at the expense of investing would likely cost you more in missed growth than you save in interest. The number you're looking for is the interest rate on every debt you carry. Write them all down. That list is your decision framework. Based on that framework, most debt falls into one of two clear categories. High interest debt, anything above 7%, should almost always be paid off before investing beyond your employer match. Credit card debt typically falls here, often charging 15 to 25%. Personal loans frequently fall here too. The guaranteed return from eliminating this debt is better than any investment return you are likely to achieve. Low interest debt, anything below 4%, generally makes sense to carry while investing. Many mortgages fall here, particularly those taken out in lower rate environments. Student loans in many countries fall here too. The cost of this debt is low enough that your investment returns are likely to outpace it over time. Between 4 and 7% sits the gray zone. And here the answer is genuinely less clear. One approach that works well in this range is splitting your available money between the two. Put half toward accelerating debt repayment and half toward investing. You reduce the debt faster than minimum payments while still building the investing habit and capturing some compound growth. The split does not need to be exactly 50-50. It can reflect how much the debt weighs on you psychologically, which brings us to the fourth factor. Before either decision, before paying off debt aggressively or investing a single dollar, there is one thing that comes first: 3 months of living expenses in a savings account, accessible, safe, untouched. Without an emergency fund, any unexpected expense, a car repair, a medical bill, a gap in income, sends you straight to credit card debt or forces you to sell investments at the wrong time. Either outcome undoes the progress you are trying to make. The emergency fund is not optional. It is the foundation that everything else sits on. If you do not have one yet, building it is the first priority, ahead of extra debt payments and ahead of investing. There is one more variable that the pure math does not capture: For some people, the psychological weight of carrying debt makes it genuinely difficult to invest consistently. The anxiety of seeing a debt balance while simultaneously watching an investment account fluctuate creates enough stress that they end up doing neither well. If that describes you, if the debt is affecting your ability to think clearly about money or making you avoid looking at your finances altogether, then paying it down faster than the math strictly requires may be the right decision for you. Personal finance is personal. The best strategy is one you can actually stick to. A slightly suboptimal plan executed consistently outperforms a mathematically perfect plan abandoned under stress. That said, be honest with yourself about whether the emotional weight is real or whether it is a convenient reason to delay investing. Both things exist. So here is the framework in plain terms. Build your emergency fund first. 3 months of expenses, accessible, untouched. Then look at your debt interest rates. Above 7%, pay it off before investing. Below 4%, invest alongside it. Between 4 and 7, split your approach. And if your employer offers a pension or retirement match on contributions, always take the full match regardless of your debt situation. A 100% return on matched contributions beats any debt repayment strategy. This week, one action. Write down every debt you carry and the exact interest rate attached to each one. If you do not know the rate, find out today. That list is the only thing you need to make this decision clearly.